Trade policies implemented during the Donald Trump administration fundamentally altered the economic relationship between the United States and Canada, creating ripple effects across multiple sectors and reshaping North American strategic dynamics. The implementation of tariffs on Canadian steel, aluminum, and other products disrupted decades of integrated supply chain relationships and forced both countries to reconsider their economic interdependence. These policy changes have generated measurable consequences for energy markets, automotive manufacturing, and cross-border trade flows, while simultaneously influencing Canada's approach to economic diversification and partnerships with other major powers. We will analyze this development through three distinct lenses. First, we will examine the confirmed trade policy changes and their documented economic impacts on key sectors. Second, we will explore the strategic context that drove these policy decisions and the structural factors that amplified their effects. Third, we will assess how these changes have influenced Canada's broader economic strategy and the implications for North American geopolitical balance. The factual foundation begins with the Trump administration's decision to impose tariffs on Canadian steel and aluminum imports in 2018. Citing national security concerns under Section 232 of the Trade Expansion Act, these measures imposed a 25% tariff on steel imports and a 10% tariff on aluminum imports from Canada. The administration also threatened additional tariffs on automotive imports, though these were not fully implemented during the period. Canada responded with retaliatory tariffs on American products worth approximately $16 billion. Targeting politically sensitive sectors including agriculture and manufacturing goods from key swing states. The automotive sector experienced significant disruption due to uncertainty over potential tariff implementation and changes to NAFTA renegotiation discussions. Major automotive manufacturers reported increased costs for steel and aluminum inputs, leading to production adjustments and supply chain modifications. The integrated nature of North American automotive production, where components cross borders multiple times during manufacturing processes, amplified the impact of these trade barriers. Energy sector impacts manifested through multiple channels affecting both countries' energy security calculations. Canadian energy exports to the United States continued but faced increased regulatory scrutiny and policy uncertainty. The administration's emphasis on American energy independence created questions about long-term Canadian energy market access, influencing Canadian investment decisions in pipeline infrastructure and resource development projects. Cross-border supply chain relationships, developed over decades of economic integration, required substantial restructuring to accommodate new tariff structures and regulatory requirements. Companies in both countries reported increased compliance costs, delays in goods movement, and the need to develop alternative supply sources. The lumber industry faced particular challenges with ongoing disputes over tariff levels affecting construction costs in both countries. The strategic context underlying these policy changes reflects broader shifts in American trade philosophy toward bilateral rather than multilateral approaches to economic relationships. The Trump administration explicitly rejected traditional free trade frameworks in favor of what officials described as fair trade arrangements that prioritized American economic interests. This approach viewed existing trade relationships, including those with close allies, as potentially disadvantageous to American workers and industries. The national security justification for trade barriers represented a significant expansion of security-based trade policy beyond traditional defense-related industries. The administration argued that dependence on foreign suppliers for basic materials like steel and aluminum created strategic vulnerabilities that required correction through domestic production incentives and import restrictions. This reasoning extended beyond immediate military applications to include broader economic security considerations. Canadian policy responses evolved from initial attempts at negotiation and compromise toward more assertive diversification strategies. The Canadian government implemented retaliatory measures while simultaneously pursuing alternative trade relationships and economic partnerships. This included increased emphasis on trade agreements with European and Asian partners as hedges against American market access uncertainty. The core analytical question centers on how trade policy tools designed for adversarial relationships affect allied partnerships and integrated economic systems. Traditional tariff mechanisms assume distinct national economies with limited interdependence. But North American economic integration had created shared production systems where trade barriers imposed costs on both sides of the border. The application of these tools to allied relationships generated unintended consequences that affected both countries' economic performance. The mechanism through which these policies created broader economic effects operates through supply chain interdependence and market integration. Canadian steel and aluminum provided essential inputs for American manufacturing, particularly in automotive and construction sectors. Tariff-induced price increases for these inputs translated directly into higher production costs for American manufacturers, who then faced choices between absorbing costs or passing them to consumers. Energy market impacts occurred through both direct and indirect channels affecting pricing and investment decisions. The emphasis on American energy independence influenced regulatory approaches to pipeline approvals and energy import procedures, creating additional costs and delays for Canadian energy companies. The automotive sector experienced compounding effects as steel and aluminum tariffs increased input costs, while NAFTA renegotiation uncertainty discouraged long-term investment planning. Major manufacturers reported difficulty in making multi-year production decisions given unclear future trade rules. This uncertainty translated into reduced efficiency and higher costs throughout the integrated North American automotive supply chain. The key variable here is often overlooked in traditional trade analysis. The success of protectionist trade policies depends on the availability of domestic alternatives that can replace imported goods without significant quality or cost penalties. In highly integrated economies like North America, decades of specialization had created situations where domestic alternatives either did not exist or required substantial time and investment to develop. This created immediate cost pressures without corresponding benefits from domestic production increases. American steel and aluminum industries had limited capacity to rapidly replace Canadian imports, leading to supply shortages and price increases rather than domestic production growth. The time lag between import restriction and domestic capacity expansion meant that short-term costs were not offset by immediate employment or production benefits. Have you ever wondered what happens when three economic giants, the US, Canada, and China, start shifting their strategies? It is like a high-stakes chess game where every move impacts millions of people and trillions of dollars. For decades, the US-Canada economic relationship has been one of the tightest in the world, a textbook example of integration. But lately, things have gotten a little complicated. The US started putting up trade barriers, like tariffs on steel and aluminum, aiming to protect its domestic industries and rally political support. While this might seem like a purely domestic move, it sent shockwaves north of the border. Suddenly, Canada found itself in a tough spot. Its largest trading partner, the one it relied on for over 75% of its exports, was becoming less predictable. This wasn't just an economic hiccup. It was a wake-up call. Canadian businesses and policymakers realized that putting all their eggs in the American basket was a risky strategy. The old certainty was gone, replaced by a new era of uncertainty. This forced Canada to do something it had been talking about for years but never fully committed to, seriously diversifying its economy. It was time to look beyond North America. And where did Canada look? East, towards the booming economies of Asia. At the top of that list was China. This wasn't a sudden pivot but an acceleration of a trend that had been building for years. China, with its massive population and insatiable demand for resources, was a natural partner. So Canada began a strategic recalculation. The goal was clear: reduce its economic dependence on the United States and build new, resilient trade relationships that could weather future political storms. This wasn't about abandoning the US, but about building a more balanced and stable economic future. This strategic shift led to a significant expansion of trade and investment between Canada and China. We're talking about a boom in Canadian exports of agricultural products, like soybeans and canola, and natural resources like lumber and minerals. But it wasn't just a one-way street. Chinese companies began investing heavily in Canada, pouring billions into key sectors. They saw Canada as a stable, resource-rich country with a highly skilled workforce, a gateway to the North American market. Let's break down where this Chinese investment went. A huge chunk flowed into the resource sector. This made perfect sense for China, securing the raw materials needed to fuel its industrial machine. But the investment didn't stop there. It also targeted critical infrastructure. Think about ports and logistics. Chinese firms got involved in projects aimed at improving the transportation networks that get Canadian goods to Asian markets. This was a strategic play to build the physical links necessary for a long-term trade relationship. Then there's the technology sector. Chinese tech giants started setting up research and development centers in Canada, particularly in hubs like Toronto, Vancouver, and Montreal. They were drawn by Canada's top-tier universities and its pool of talent in areas like artificial intelligence. This created high-paying jobs and brought new expertise into the country. However, this deepening relationship came with a complex set of trade-offs. On one hand, you have economic growth, job creation, and diversification. On the other, you have concerns about national security, intellectual property protection, and the influence of foreign state-owned enterprises in critical sectors of the Canadian economy. The immediate consequences of the trade pressure from the U.S. were stark. Industries that relied on cross-border supply chains were hit hard. For example, the auto industry, which is deeply integrated across the U.S.-Canada border, faced significant disruption. Parts would cross the border multiple times before a finished car rolled off the assembly line. New tariffs added costs and complexity at every step. This created a powerful incentive for businesses on both sides of the border to lobby their governments for a return to normalcy. The economic pain was real, and it demonstrated just how interconnected the two economies truly were. So where do we go from here? What does the future of the North American economic relationship look like? We can imagine three potential scenarios. The first is a Fortress North America scenario. In this version, the US, Canada, and Mexico double down on their regional partnership, creating a more integrated and self-sufficient economic bloc to compete with the rest of the world, particularly China. This would involve strengthening supply chains, harmonizing regulations, and presenting a united front on global trade issues. A second, more disruptive scenario is one of continued fragmentation. If trade disputes persist and political tensions remain high, we could see a further breakdown of the North American partnership. Canada might accelerate its pivot to Asia even more, while the US continues to pursue a more protectionist path. This would be a costly and inefficient outcome for everyone involved, leading to higher prices for consumers and lost opportunities for businesses. It's a future where old alliances fray and new, uncertain ones are forged. But the most likely path forward, what we might call the baseline scenario, is one of gradual restoration and compromise. The economic logic for a strong US-Canada partnership is just too compelling to ignore. In this future, political leaders find ways to resolve their differences, recognizing that cooperation is mutually beneficial. We'd see a dialing back of tariffs and a renewed focus on strengthening integrated supply chains, especially in strategic areas like electric vehicles and critical minerals. This doesn't mean Canada will abandon its diversification efforts. Instead, it will pursue a dual strategy, repairing and reinforcing its relationship with the US while simultaneously building stronger bridges to Asia. It's a pragmatic approach, a balancing act designed to create a more resilient and prosperous future for North America in a rapidly changing global economy. Thank you so much for watching. If you found this breakdown of global economics interesting, make sure to like this video and subscribe to the channel for more deep dives into the forces shaping our world. See you in the next one. The implementation of this scenario would require both countries to accept modified terms that impose some costs relative to previous arrangements, while providing sufficient benefits to maintain political sustainability. American manufacturers would need to accept higher costs for some Canadian inputs in exchange for enhanced access to Canadian resources and guaranteed supply relationships. Canadian companies would need to accept some constraints on third-party relationships in exchange for restored access to American markets. The divergent scenario emerges if both countries pursue alternative economic arrangements that reduce their mutual dependence. This outcome would involve Canada accelerating diversification toward Asian and European markets, while the United States develops domestic alternatives, supplies for Canadian products. The process would require significant adjustment costs, but could result in more resilient economic relationships for both countries. Key indicators for this path include sustained expansion of Canadian trade relationships with non-American partners and American investment in domestic capacity for products currently imported from Canada. Chinese or other foreign investment in Canadian resource sectors that creates alternative market access would support this outcome. American development of domestic steel, aluminum, and energy production that reduces Canadian import dependence would indicate movement toward economic separation. The implications of this scenario include reduced vulnerability to bilateral political tensions, but also higher costs for both countries due to less efficient production and supply arrangements. Both countries would need to develop new institutional relationships and supply chain networks while managing the transition costs of reduced economic integration. The integration scenario involves deeper North American economic cooperation that addresses American strategic concerns while providing Canada with enhanced benefits from the partnership. This outcome would require American willingness to offer positive incentives for Canadian cooperation and Canadian assessment that enhanced integration provides better outcomes than diversification strategies. This scenario would involve joint development of North American strategic resource capacity, integrated defense industrial cooperation, and coordinated approaches to third-party economic relationships. Canadian access to American defense markets and technology sectors would provide positive incentives for accepting constraints on relationships with strategic competitors. American access to Canadian resources and geographic advantages would justify offering enhanced partnership benefits. Indicators for this scenario include joint infrastructure development announcements, expanded defense industrial cooperation agreements, and coordinated policies toward Chinese investment and trade relationships. Enhanced research and development partnerships in critical technology areas would demonstrate commitment to deeper integration. Success would require both countries to view enhanced partnership as preferable to available alternatives. Each scenario carries distinct implications for global trade patterns and strategic competition. The baseline scenario would maintain current competitive dynamics while potentially creating precedents for managing trade disputes between allied countries. The modified relationship frameworks could influence how other allied partnerships address similar tensions between economic integration and strategic autonomy. The divergence scenario would demonstrate the limits of economic pressure as a tool for managing allied relationships and could encourage other countries to diversify their economic partnerships to reduce vulnerability to trade pressure. Success of Canadian diversification efforts would provide alternative models for countries facing similar pressure to choose between economic partners. The integration scenario would strengthen North American strategic autonomy while potentially accelerating competition for partnerships with other resource-rich countries. Enhanced North American cooperation could influence European and Asian countries to develop their own integrated economic arrangements to maintain competitiveness in strategic sectors. Our analysis reveals several confirmed patterns and areas of continued uncertainty. The application of trade barriers to allied relationships generates immediate costs for both parties, while creating political pressures for policy modification or alternative arrangement development. The integrated nature of North American economic systems amplifies these costs and reduces the effectiveness of unilateral trade pressure as a policy tool. The availability of alternative economic partnerships provides target countries with options for reducing dependence on relationships that involve excessive policy constraints. Canadian success in developing alternative relationships demonstrates that trade pressure effectiveness depends on target countries lacking viable alternatives to existing arrangements. However, significant uncertainty remains regarding the long-term sustainability and effectiveness of diversification strategies versus restored traditional relationships. The costs and benefits of alternative economic arrangements require extended periods to fully materialize, creating ongoing policy tensions and adjustment challenges. The strategic implications of reduced North American economic integration for broader alliance relationships and global competitive positioning remain unclear. We will continue tracking confirmed policy implementations, trade flow data, and official statements regarding economic relationships and strategic partnerships. The interaction between trade policy tools and alliance management provides insights into broader patterns of economic statecraft and strategic competition in integrated global systems.